they've got enough cash to pay off all of their debt twice over, more than twice over. So this is a fantastically solid balance sheet. Hey everyone, so if you are new, well, I'm glad you found my channel. What I'm trying to do here on the channel is explain that investing in the stock market is more than just buying a company you love and that's it, and thinking it's going to the moon like everyone says it's probably going to. Look, this mentality is going to get a lot of people into trouble, and I'm hoping we can avoid it. My strategy is to look at an investment based on its financials, just like we would if we wanted to buy an entire company and run it ourselves. Look, just follow along to learn how to do this yourself. Plus, we will have a target buy price, hopefully by the end of this video. Look, it's part art and part science anyway, and the more practice we do, the better we're going to get. And if you do actually get any value out of this video, make sure to hit that like button for me so I can get some feedback, and let's jump into it. So the company we're looking at is IAC Interactive Corp, and this one, as you'll see, is a little different to the ones we've done in the past because it's a bit more of a sum of the parts valuation, which I'll get to at the end. I'm still going to go through my 9-point checklist and give you my opinion. So let's sort of talk about what IAC actually is first. So IAC is, it's called the anti-conglomerator, or in my words, I call it sort of got this spawner DNA like Monish Pabrai would talk about. And they have sort of internally built up or acquired companies over the years. And then once they get to a certain size where they can stand on their own 2 feet, they get spun out into their own public companies. For example, Match Group, so that's Tinder, TripAdvisor, Vimeo, Live Nation, Lending Tree. These are all examples of spin-offs that have been done. And it's a great way to reward shareholders and return value back to shareholders because you get all these shares in this new company that you can sell or keep or do whatever you want with. And it's just a great way to return money back to shareholders. It's very different to how most businesses, it's very rare, a rare business because most businesses don't ever spin their little, spin their spawners off. They keep them under their own roof like Berkshire Hathaway. This is sort of the opposite of Berkshire Hathaway, but still works. Barry Diller is the person leading the charge here. A strong capital allocator. He's come from the entertainment industry. He's been doing this for over 26 years now and has done a fantastic job. It's currently at about $11.7 billion market cap, but it would be, I think it would be well over 60 billion if they kept all the companies and what they're actually worth. So I think apparently for shareholders, since buying back shares and all these things, it has accumulated around about $100 billion worth of value apparently. So that's a fantastic, I think it started at $250 million and now it's 100 billion roughly if you were a shareholder at the start. So incredible return on investment for any shareholders in the early days. The spin-offs also allow for long-term growth without restrictions because things like Facebook and Google and stuff like that, they get so big that they don't really, it's difficult for them to grow because they've reached these huge sizes. Now, by spinning off all of these little companies and using the money that they make from the spin-offs to grow new companies, it kind of allows them to grow for a lot longer period of time, in my opinion. So they're not going to fall to this big fish, small pond syndrome that a lot of the big trillion-dollar companies face. This will hopefully be able to compound for many more years. Now, moving on to revenue growth. Now, what I'm going to do is I've got this table here that's come from IAC themselves, and you can see that they've broken it down into Angie Home Services, Vimeo, which is actually just spun out, Dotdash, their search segment, and then emerging and other, which is all of the other stuff. And you can sort of, they break it down on their year-on-year growth. So for Angie Home Services, it's sort of about, looks like it's averaging about 10% growth in revenue. Vimeo was doing like 30 to 50% growth. They spun that out, but that's pretty epic. Dotdash has been doing exceptionally well, somewhere in the 20% range revenue growth. Search has been negative for a long time. It's only just turned positive, but positive in a strong way. They're sort of doing a restructure of their search stuff. They used to have, this is actually Ask Jeeves, if anyone remembers Ask Jeeves back in the day. IAC actually owns this company, owns that brand. So don't know really what they're going to do with that because Google obviously dominates search. But anyway, and the emerging and other, that's growing really fast for them. As you can see, it's been looks like it's 50 to 100% revenue growth. It's a small segment, but it's still growing very quickly. So revenue growth across the board here is actually strong, and it's been quite good. Everything but search. Dotdash and Angie definitely leading the way here. Now let's quickly go look at the gross margins, and as we can see, they're somewhere in the 70-80% range. That's fantastic. Anything above 40% is actually really strong. So this is a software company, essentially. It's an internet company. So we should expect high gross margins, and that's the case. Now let's go look at return on invested capital. And this is going to be a bit tricky because they keep spinning off their companies. They've done Vimeo this year. I think they did Match Group at the start of 2020. It makes this return on invested capital number really all over the place. And trailing 12 months is 19%, but it was 4% last year, 9%. It's going to be up and down because of these spin-offs. So it's going to be a bit tricky to calculate this one exactly. So I am going to give them a cross here for ROIC, but with all the spin-offs, it does make things quite messy. Next, we want to go have a look at debt. So the first thing we're going to look at in the debt is the current assets, and that's at 3.8 billion. And the total current liabilities is only 600 million. So we wanted to see that current assets significantly higher than current liabilities. They're not going to face any short-term problems. So that's a big discrepancy there, which is fantastic because that's exactly what we want to see, a lot more current assets. Their current assets at 3.8 billion. If we look at their total liabilities, it's actually only 1.5 billion. So they've got enough cash to pay off all of their debt twice over, more than twice over. So this is a fantastically solid balance sheet. Next, we go look at free cash flow. Now, unfortunately, this is a bit messy because, well, Match Group was bringing in a lot of their free cash flow, but then they spun that out. Then Vimeo was also bringing in lots of cash flow, and they've spun that out. So free cash flow is really not a good measure here of the quality of the company. So I'm probably just going to let this one slide at the moment. But look, before the Match Group spin-off in 2020, free cash flow was growing really strong. Then that spun out, and then it went back down to 93 million, and it's grown again. So I guess it's growing, that's fine, but not a good way. This is not the measurement we need to look at. Now, if you're interested in the brokerage accounts that I use for my investing, I use Interactive Brokers and Saxo Bank. The reason I use these is because it gives you access to international markets. There's low fees. I don't really like Robinhood because, well, firstly, I can't get access to it, but they don't give you access to international markets. And look, I don't really believe in the whole free trading, free commission thing. They kind of selling your data onwards, and I'm not a big fan of that. I like Interactive Brokers in particular. And if you want to just even you look at a demo account, the link in the description, you go through that and you can play around with the demo account and see whether you like how it looks. Okay, next up is shares outstanding, and we want to see this number hopefully getting smaller. If it's getting smaller, it means the value of our investment in the company is getting bigger. But if the shares outstanding is getting bigger, well, we're getting diluted. So I look at the shares, and it was stable at 85 million, and then it bumped up to 91. Now it's 89. So that's about a 1% increase per year. It's very small, but it is a slight increase. So we'll have to give that across. Now we look at insider ownership because we want the incentives of the management team aligned with us as shareholders. Now, the Barry Diller, who started all of this 26 years ago, he has a 7% ownership in the company, but his compensation is actually pretty high, $50 million a year, and he's got about $800 million worth of stock. Obviously, his net worth is tied a lot closer to the stock value rather than the compensation, but that compensation is high. Joseph Levin, the current CEO, he started 6 years ago. His compensation is $200 million. That is massive. And he owns double that at $400 million worth of shares. But if the share price goes up or down, he's getting paid $200 million. That compensation is way too high. Considering Charlie Munger, Warren Buffett, they pay themselves like $100,000 or $300,000. It's insignificant compared to the shares that they have. I don't like this. I could probably give it a tick because they do have a pretty decent percentage of the company, but that compensation is too high. So I'm actually going to give that a cross. All right, so next up is the super investors. And the reason I look at super investors that have invested in this company is because, look, I'm not that smart. And if it's gone through someone else's filters who is smarter than me, well, I'm going to give that a tick. So to look for that, I'm in Simply Wall Street, and I'm looking at the top 25 shareholders, and I'm looking for anyone that I'm familiar with. Barry Diller is the third biggest owner in the company, which he started, so that's fair. SureSpring Partners is the one that stands out to me down here near the bottom. They have $250 million. It's actually SureSpring Partners. That's Dennis Hong, someone who I think is a fantastic investor. And this is actually their biggest position at SureSpring Partners. So for me, that's a tick of approval, and I'm happy to see someone that I think is smarter than me invested in the company. Now we get to the most important thing, which is the price. Now, like I said at the start of the video, we're going to do this a little bit differently. We're going to do a sum of the parts valuation because that free cash flow was all over the place. It's probably not fair to use free cash flow to value this company. So I'm going to do a net asset value kind of thing. And this is what it looks like. So they've got 84% ownership in Angie Home Services, which is a publicly listed company. So that current valuation is $4.5 billion. I think Angie is overvalued, so I've knocked that down to $3.5 billion. That's closer to what I think its fair value is. So I've moved that down. MGM Resorts, they own 12% of, and that's currently a publicly traded company as well. That's worth about $2 billion. Dotdash, this is my estimate now, and I think because it's growing at 27%, I think it's worth about $800 million. Care at about $500 million. Care.com, that is, sorry. They own 25% of Turo. Turo is a car trading. I think you buy and sell cars on Turo. Or maybe you rent cars. I don't know. I'll have to check. But that's about $250 million, I think. The other 140 odd companies, I've estimated it to be about $500 million. That's very rough. That's just my estimate. And they also have actually, if you take out we saw the balance sheet, all their cash they had. If you take out actually all their debt, they have a net cash position of $2.6 billion. So my estimate at the moment is around about that $10 billion. And it's a little bit rough. I could probably go through these in a lot more detail and look at these other 140 companies, but I think this is a pretty good guide at the moment. Now, like we said early in the video, right at the start, I said that the market cap is about 11.7 billion. So if the valuation, I think it should be worth about 10 billion. So it's slightly overvalued, but look, it's probably about fair value right now. Okay, so now my opinion is this. A lot of this is pretty hard to calculate. My valuation was far more of an estimate than any sort of accurate number, but roughly fair value is probably where I'd put it at the moment. I love that balance sheet that they have. Fantastic to see their net cash position being so strong. Look, that insider ownership, look, it's there, but the compensation is too high, which I don't like. Now, I love how they have this spawner DNA, how they're spinning off all these different companies to return value to shareholders. I think this is a great culture and something that really did interest me in this company in the first place. Now, like I said, the sum of its parts valuation tell me it's probably about fair value right now. It has a great history of success, but the future is really hard to predict. So projecting this out in the future is going to be pretty tough to do. But there are multiple ways it can win. They have 150 different potential winners. So if it is at fair value, we only have to get one of them to be amazing and it's going to return a lot of value back to us. But because that future is hard to predict, I want a margin of safety into something like this. And I want it to turn into a really low risk but high uncertainty kind of investment where you have all this different upside potential, but the risk is really minimal. So I would probably want to buy this, I don't know, maybe at like 6 billion, 7 billion market cap. That would be getting pretty interesting for me, considering they have nearly 3 billion in cash. So you're getting a lot of these companies then for hopefully closer to half price. And then that would be more attractive to me. Now, I hope you did enjoy that high-level valuation of AIC Interactive Corp. Make sure you subscribe to the channel before you go, and I will see you next time.